folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. A very positive day for the S&P 500, currently sitting at about 5806 with a very strong rally after some weekend news. We'll get to that weekend news in a second, but first I just want to run through a couple of levels just to let everybody know where we're at. S&P 500 is down about 1% year to date. So it's down about 5.5% from the peak back in February and up almost 16.5% from the trough on April 8th. So once again, sort of highlighting the Mr. Toad's wild ride in the market of, pretty big dip and correction almost to bear market territory, followed by a massive rise on the other side, and also highlights some of the dangers of market timing, which is a subject for another video. Meanwhile, the Barclays Ag, the bond market, if you will, up about 70 basis points for the year on a price level. Remember that has about a 4% dividend yield associated with it. So if you want to think about its return for the year so far, year to date, you're kind of in that 2-ish% land to the positive. Bonds performing inversely to equities, which is what we like to see. And just to round it out, all of the equity markets outside the United States are up about 12% year to date. And the Russell 2000 as the laggard in performance is down about 6% year to date. Really seeing the benefits of kind of diversification. If you sort of spread your eggs out along a whole bunch of different baskets, you're not necessarily concentrated in that S&P 500 formula. That S&P 500, not necessarily the world's best asset class. In fact, close to the bottom in terms of overall performance. So with that, let's focus to the news. We had some good news over the weekend on the trade war front with talks between the United States and China generating far better results than anticipated. So almost like a ceasefire or cooling off in the trade war. Both sides announced a 90-day period of cooling off where they would reduce some of the tariffs that have been announced, replace them by kind of a 10% tariff across the board. I will spare you all of the back and forth of what all that means and just give you that the U.S. tariff rate on Chinese goods will drop to about 40% for the next 90 days. And the Chinese tariff on imports of U.S. goods into China will stay at about 28% for the next 90 days. So really a step in the right direction for that, trade conflict. And markets, reacting very, very positively as a result. Once again, to the extent that we can navigate these trade conflicts in a way that doesn't completely shut down trade between the two countries, I think that will help overall economic growth and overall economic activity here in the United States. So market clearly reacting very positively to that news. The other thing that is going on, which has sort of been lost in this whole tariff news, is the fact that it is earnings season. And in fact, it is the very tail end of earnings season. We've had about 450 companies report within the S&P 500, so about 90% of the way there. And we've seen about 12.3% earnings per share growth or net income growth, which is well ahead of the sort of plus 7% consensus, about 5 percentage points ahead of that number, which is good. It's a good earnings season. Companies reporting strongly. Of course, not many people care too much about that because the market is very, very, very forward-looking. And so more eyes focused on what do we think comes out of all of this economic policy as opposed to current earnings expectations. But for what it's worth, those earnings numbers came in better than expected. It is a busy week. We have a slew of economic data coming out this week, including the CPI numbers, so preferred read of inflation. We've got consumer sentiment coming out on Friday, so we'll get a sense of how consumers are feeling about everything that's going on out there. And we've got Fed speak, so we'll have 7 different speakers from the Fed speaking at various times, including Mr. Powell on Thursday. where all 7 of them, at least in our opinion, will probably say how many different ways can we tell you that we're going to be data dependent and wait to see what the data tells us before we decide what to do. But we'll get to hear that message about 7 times, which is lovely. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.